Fantastic Four bombs at the weekend box office. This is exactly what media stocks did not need. Another stumbling block. It all started last week when Disney reported, as part of its quarterly earnings, that its cable sports giant ESPN saw subscriber losses due to so-called skinny cable package offerings. Well, shares tanked by 9% last week, dragging down Viacom, Time Warner, Comcast, and 21st Century Fox, the parent of our company, or their a parent of our company with them. And now Fantastic Four disappoints. Are customers cutting the cord, or is the content to blame? In a Fox Business exclusive, we have Tuna Amobi. He's S&P Capital IQ Senior Media and Entertainment Analyst, and Jim Frischling. He's president of New Oak Capital. Tuna, so Fantastic Four is completely separate from what happened to Disney last week, which was, ESPN lost some subscribers. But do you see any connection between the two and how they're affecting media stocks?
Well, I think the only connection is in terms of the proximity of time. But I think it's really clear that it's been a challenging couple of weeks for media stocks, really on the confluence of factors related to secular shifts in the pay TV landscape, as well as company-specific issues like the Fantastic Four performance that you saw. So neither of those obviously is a good thing. I think what we're seeing right now is a recalibration of investor expectations with regard to the media industry, which, as you know, has really had a very phenomenal rally over the last several years. Coming into this year, I think we're now starting to see media executives embrace the fact that cord cutting is here to stay. So whereas in the past they had actually dismissed those concerns, now it's become a reality, and now we're seeing more and more responsive action from companies trying to mitigate the potential impact of this issue, which, by the way, we think will remain an overhang in the near term.
Let me bring in Jim, because, Jim, you're the guy who sits there and picks and plucks certain stocks. Look, Disney's moving higher today after falling precipitously last week. Same with Fox A. Look, that would be 21st Century Fox. It's slightly lower, but Comcast, the parent of NBC Universal, which came out with Jurassic World, but they also have a bunch of cable operations. Will cable hurt the movie parts of these big media giants?
Well, I do think the ESPN blow was real because people had felt they were immune. Streaming and trying to compete with live sports, there really was no alternative. So I think that was a real blow. On the Fantastic Four, I haven't seen it, by the way. I guess most people haven't seen it. But I think the answer was it's a bad movie. It got hit by the critics. There were some creative difficulties. It's a bad movie.
You know there's trouble when my 11-year-old who went last night said, I like the graphics.
But I think at the point of Disney popping, I still think content is king. And I think more Americans, actually more people globally, are watching TV. They want good programming. So while these stocks are all priced to perfection, and I think there is some cord cutting, to use that, I guess that's the expression now, the fact is people want good programming, and companies like Disney and the other ones you mentioned have the best content. And if they could actually make sure that product gets to in the right delivery channels, I still think they're going to be the winners.
But Tuna, you've got other operations that are snagging the eyeballs that these guys took for granted. And we're talking about Netflix, Hulu, Amazon. Hulu not publicly traded, but Netflix and Amazon are, and they're now grabbing these eyeballs that used to be exclusively for the Time Warners and the Foxes of the world. So now I ask you, what happens, and do you need to come out with incredible content? And I'm thinking Star Wars.